Hello, and welcome back to the Tax Advisor and Biz Coach Success Podcast. The purpose of these episodes is to help entrepreneurs become more successful, avoid tax and other business headaches. Remember to tune in frequently, as we will be sharing tips, secrets, and expert recommendations in how you can manage your finances, improve wealth, and grow your business. Please like, share, and subscribe. Here's your host, Liz Soria.
And today I have a special guest joining me to talk about his expertise and how he may help you. So welcome again, Kirk. How are you today?
I'm doing great. Thanks for having me on, Liz.
No, it's actually my pleasure. Kirk Chisholm is a principal and a wealth manager at Innovative Advisory Group, an independent RIA, a registered investment advisor located in Lexington, Massachusetts. He has been providing financial advice to individuals and families since 1999. Kirk's influence and innovation has promoted changes in many areas of the wealth management industry. You have an industry combined experience of 18 years, which is long time, Kirk. And Kirk provides a different perspective of many commonly held beliefs when it comes to portfolio management, retirement investment, financial planning, inflation, economics, and other personal finance topics. His rare expertise with alternative investment held in self-directed IRAs has helped many investors invest in their passion. Kirk is an experienced media personality. He is frequently quoted and interviewed by industry media outlets in print, audio, and video media formats. He writes frequently for industry publications and media publications. He appears as a guest in various podcasts, including this one. And Kirk was recently acknowledged as the seventh most influential financial advisor on Investopia Top 100. Well, congratulations and all those accomplishments, Kirk.
Thank you, Liz. It's nice to be recognized.
It is, right? We work hard, but it's nice that others can actually recognize what we dedicate ourselves, and that's wonderful. So, Kirk, what I like to do at this point is make this recording as productive as possible. So, I like to ask you something, and hopefully you can give us the best tips and information. And first, I'd like to start by asking you, because I know that it's not too many people understand the difference between what is a RIA, which is a retirement investment advisor, versus to what a certified financial planner is. Can you do me a favor and briefly explain the difference between the two then, please?
Sure. I'd love to. Actually, I'd put another category in that question too, is broker dealers, because I think there's a lot of confusion around designations and terms in the industry.
All right.
So, what a registered investment advisor is in essence a financial advisor. It's somebody who is licensed to provide advice, and they can get paid a fee for that. The difference between that and a broker-dealer is a broker-dealer is a firm where we're also providing advice, but they can get paid commissions. With a registered investment advisor, we are fiduciaries. So we have an extremely high standard of care, which requires us to put our client's best interest above our own. So, ethically, it's a very high standard of care. And, investors who are looking for financial advice should preference firms that are RIA only, because some firms do have a hybrid model where they work as a broker. They work with a broker dealer, but also with an RIA. So essentially, it allows them to do both. But if they're RIA only, where they can only provide advice for a fee, it tends to align the interests of the investor and the advisor more clearly than with a broker dealer, where the intentions can kind of skew a little bit. Now, the certified financial planner is a designation, so that's a little bit different in this characterization. So somebody can have a CFP, which is a quality designation that a lot of advisors have. And what it essentially means is that the person has they've been through an educational process, and it means they have a minimum competency in certain topics. So it basically says that this person is at least somewhat knowledgeable enough about these areas so that they can discuss it intelligently. It's certainly not a requirement in the industry, and a lot of people don't have it. I do not have one. I feel that, for me, going through academic studies is not high on my list. I've 18 years of experience. I've learned all of these things. But if somebody is an advisor, and let's say they've only been doing this for 2 years and they have a CFP, it removes a lot of that experience that I may have learned on the job, where they've learned it academically, which is just as important. So I'm not at all belittling the designation, because I think it's very valuable. I think it's something that just says, okay, this person can talk about insurance, estate planning, financial planning, all these topics that are relevant to our industry. So it is an important designation. It's just not a requirement. And I think that a lot of investors don't really understand it well enough.
Right.
There are, I believe, over 208 designations in the financial service industry.
Crazy, isn't it?
Yeah, it's not hard to be confused at all.
Okay.
I get confused at all the designations. So,
And I bet you they're still coming up with new ones too, right? So it's kind of hard to keep up with it.
well, that was as of 2011. I'm sure there's more now.
Okay. And that's great. Thank you so much for making that clarification, because
Sure.
the reality is that I know about it, and when I discovered a couple of years ago, I was actually impressed myself, because I thought, wow, I thought that, and again, this is not just downgrading any credential here, but I was surprised that CFPs that they normally do work almost serve like a salesperson. They do have that commission structure, and I think as a RIA destination, you're more in, like you said, in the interest of the client. So you want to make sure that their investment it's definitely going to be a good purpose for them, instead of looking at how much you're going to make up front. And again, it's all about the best of the interest of the customer, right? And I always believe that should come number one as a priority when we serve our customers. So thank you so much for clarifying that. Now, let me ask you something, Kirk. How and when did you get started in your business, by the way?
Yeah, so I started right out of college. I started working at Payne Weber when they were still a firm. They got acquired by UBS, but I started in '99, which was a very interesting time to start, because I started in December of '99. So if
Oh,
anybody's remembered the huge run up we had for 20 years in the market, straight up, with the tech bubble, I missed all of that.
good for you.
Yeah, well,
That's good.
people in my profession certainly get a lot of benefit out of working there. It was a very good time to be involved in the markets. However, the one thing I will say is, looking back in it, and I say it was a really fortunate thing for me that I missed that, because what it taught me was risk management. And from 2000 to 2003, the markets pretty much went down continuously, and you really understand the value of risk management in times like that, because if somebody had started in 1990, they probably would just completely overlook the fact that markets can go down. And I
Sure.
think the last 10 years is a testament to that. The markets have pretty much gone straight up for 10 years. And
That's a long, long time, and we both know that.
yeah, and if you have not experienced a bear market, you don't understand how to manage risk. And I think risk management is one of the most important things you could do. And if you look at the law of numbers, and I'm sure you appreciate this, Liz, because of your profession, but the numbers are pretty interesting. If you lose 50%, making 50% doesn't get you back to where you started. You need to make 100% to get back where you started.
That's right.
So it's not something that people appreciate until it happens to them. And I think what's important is, if you can, making money is important. I mean, that's definitely important. And the markets do go up and down. But if you don't have a risk management strategy to take care of the times when the markets are turning down, then you really lose sight of your long-term goals. And so we've developed a lot of strategies over the years to manage that risk. But my career has taken many twists and turns. So I worked in the broker-dealer channel for about 10 years, or I say about 8 years, and then I started my own RIA in about 2008, and we've had that ever since, and it's been great. I Making that switch from the broker-dealer side to the RIA side was certainly psychologically challenging, because you spend a lot of time in one area and you make the switch and you give up some licenses. It's hard to let go of the licenses. But when I did, I realized, I was saying to myself, and I've said this to my friends, why didn't I do this earlier? I mean, what did
Right.
what did the broker-dealer side do for me? It creates a lot of operational challenges for us because they're very strict.
Right.
Primarily because they're selling product. We don't sell product. I don't get paid any more or less if I put people in cash or if I put them in mutual funds or stocks. There's no different incentive structure for me. So it aligns my interest with my clients. Not that they wouldn't have been otherwise, but it from a advisory standpoint, there's no other bias in my purview. So I really can't say strongly enough that the investment advisor side is so much more beneficial for us as advisors as well as it is for clients.
Amazing, yeah. And like I said, I know that I was familiar with it, and when I came across, this destination, I was surprised of, the two, separations between, two destinations, and I think that's great that you are running a successful business, and I mean, for me, I mean, I prefer to have expert guests like yourself that can bring so much to, to the podcast, because there's a lot of business owners out there that they're looking into different ways of making passive income. And like you said, the stock market has been strong and solid for almost 10 years. And I went through the 2007-8 crash. So, and I lost quite a big chunk of money because, again, unfortunately, I was in a portfolio, what they call the H portfolio, right? And that I think it was not really meant for everyone in that age, because we all have different perspectives of things that we want to accomplish for the future, right? So some of us, we're willing to take a little more risk, others are not, but definitely there was no management in my portfolio, and I lost more than 60%, and it was obviously devastating. And I think that people who are listening to this podcast, they probably feel the same way. People have not recovered even after this 10 years. I mean, money was lost. So other than that, I mean, what are the alternative investments that you offer, and how are they different from traditional investment, please, Kirk?
Well, I would like to point something out before I answer that. Losing 60% or 50% during that time was completely normal.
Yeah.
And not to put a negative spin on it, but it was. And we can talk about this later in the podcast. But one of the challenges, one of the reasons that we started this firm, is to be able to offer non-correlated assets, because during that time, unless you were in gold, cash, or treasuries, effectively you most likely lost around 50 to 60%.
Yeah, that's exactly what happened. Yeah. Mm-hmm.
Because when the markets crashed, everything became correlated and everything performed. Not everything. A lot of things performed the same. And that's not how portfolio construction should work. If you're diversifying properly, it should not do that. That's the whole point. But what's happened in the last 20 years is the model of diversification has changed dramatically. And we've done some really good research on our site on this, which just shows that in normal times, diversification works, and in crazy times like that, it doesn't work. And that defeats the point of diversification. So when we started the firm, one of the goals was to be able to invest outside of the stock market, to find investments that make sense, that are not correlated to your traditional investments. So we don't offer alternative investments because we're an investment advisor, so we don't sell any sort of investments, but we do go out and find investments for clients that are looking for certain things, and a lot of it, clients bring us certain alternatives. As, hey, look at this and tell me what you think. But the alternative.
Kirk, for some reason, I cannot hear you. Kirk?
Sorry,
Yep,
Liz.
got you back. Oh, thank God. Okay, I'm glad. You're
my
back. Okay.
My headphones fell off. Yeah, sorry about that. So,
No problem.
so basically, I mean, alternative investments are an interesting asset, and Wall Street looks at them differently. Wall Street has a great history of creating terms and kind of morphing them in the let's just say not the right direction. So alternative investments in their mind are things other than traditional
Stocks and bonds.
stocks. Yeah, and normal buy and hold stocks, bonds, and mutual funds.
I call it buy and hope, right?
Buy and hope. Yes. A good stat for you. If you had bought in the peak in 2000, I think it would have taken you about 12 years to actually get back to where you started. And that's just the S&P 500.
Unbelievable.
So you would have lost 12, 13 years in there. I think it was like 12 and a half years. You would have lost that period of time. Just time value of money. Your money wouldn't have grown. You might as well have just stuck it under the mattress, or got 0% in a bank account. That's the equivalent. So it's really important to look at portfolios in this way. So Wall Street looks at alternatives as, well, it's not just buy and hold or buy and hope. It's, hey, we can buy, and we can also short. We can have a different strategy, but it's still owning securities. We look at it and say true alternatives are things that are not securities. They're outside of the stock market, if you will. And we're very agnostic when it comes to any investment. We do not have a preference, whether it's stock, funds, and mutual funds, or horses, or real estate. We don't have a preference. We look at every investment individually in of itself and say, is this a good investment? So when it comes to things like
give us some examples. I mean, what we would consider what alternatives are, because again, the traditional, as far as I know, is obviously the bonds and the actual mutual funds, right, and in stocks. What happens? People have got burned, and they still don't trust the market at this point, even though it has done so well. We are all kind of nervous, the ones that we are reinvesting again, in the aspect of knowing that, well, whatever goes up must go down. So we I think most investors right now, from my opinion, is that we're very concerned because we've done so well that now having a roller coaster and seeing what's going to come ahead. I mean, eventually it's going to go down. We just don't know. It's like the crystal ball. When is that going to happen, right? So what are those examples of alternative investments for people who are listening to this audio?
Yeah, and so I'll give you some. It's a great question. I'll give you some good examples. So alternative investments are things like real estate, rental property, or raw land, or private mortgages, or tax liens. On the real estate side, you have physical gold, precious metals, gold and silver. Cryptocurrency is a big hot topic now. Horses, farmland, livestock, airspace rights.
Wow. Airspace. Okay.
Yeah, I mean, in the cities in New York, airspace rights is certainly an asset, and you could look at mineral rights, private company stock, equipment leasing, payday and title loans. I mean, there's a virtually infinite supply of alternative investments out there, and typically what we tell our clients is the best way to make the most of your investments is to invest in what you know.
Yes.
So if you are an expert in real estate, you should not be investing in tech stocks. Invest in what you're most capable to invest in.
That's a good advice. Yeah. And what about safety, right? Because again, Bitcoins is something that, like you said, it's a very hot, a trend. But if you look at it in the last, I think, year, I mean, I think there was like a 900 percent of almost of price value on those bitcoins, and then just last week I think went down to like 30% of it just drop. So I mean, it's kind of scary, when you see these alternatives, but at the same time, it's a matter of how much risk you're planning to do. And I think just sticking to what you have experience, or have an advisor that can help you in the field. I mean, I think that's really important.
Yeah, and I think it's great you pointed out. Now, I'll touch on the cryptocurrencies because I think it's a hot topic, and
Yeah.
a lot of people are interested in it. And we've had a number of clients and prospective clients come to us and say, "I want to do this." And earlier this year, in January, we actually put some money into a publicly traded security that invests in Bitcoin. So that did pretty well. But I will say this: the way we look at, let's say, Bitcoin specifically, and I think this is really the consideration that people should look at when they're investing in cryptocurrencies, is we look at Bitcoin as what we would call an asymmetric risk investment.
Okay.
So you could very easily lose 100% of your money, and that's a very real possibility, right?
Wow.
But on the upside, you could easily make 10 to 50 times your money.
Yes.
Like, that is also a real possibility.
Right.
And if you went to a casino with those odds, I would go to a casino with all my money every day and all day, because when you're flipping a coin, it's
Mhm.
a 50% gain or loss. But when you have a chance to lose your bet versus making 10 to 50 times, that's that's what all the smartest and brightest hedge funds look for, is those type of trades. But that being said, that doesn't mean you put all your money in it, right? That's not how you manage money. That's gambling. You could take a small amount, say something that's reasonable for you, that if you lose it, it's not going to be the end of the world. Take $1,000 or $5,000 or whatever it might be. That is, if it's this has to make sense for you. I mean, the way we look at it is, we would say, let's say 1% of a portfolio. That's a minor enough amount where even if it did go to zero, then you're still okay. But when you're managing risk, you look at things like that and say, okay, the trade-off makes sense, because if it goes up 100%, here's a risk management technique for people listening to the show. Let's say something like that goes up 100%. You sell half of it, which is your original investment. You take that out, and then everything else is just profit.
That's true.
So that's what we did earlier this year. It went up 100%. We took out our principal, and the rest is just profit. So even if it goes to zero, we haven't lost anything.
That's right. Your capital is still there no matter what, and that's so true. Okay, so definitely, I mean, like you said, there's alternative, options out there. I guess it comes down to the rule of thumb, Kirk, and as a professional, it's not about putting just everything in one egg nest, right? We have to do that, alternative. We need to make sure we diversify, because when we don't, we're taking too much risk. And I think that it's very promising, the Bitcoin. Just that I myself, I don't feel yet comfortable. I think it's just, it hasn't been out there for too long. So there's really no history. And like you said, suddenly you could lose it all, or you can make 100%, which is phenomenal, but we know the risk involved with that. So what have you seen some of the biggest mistakes the investors make when it comes to alternative, investment?
Well, one of the biggest mistakes we see, and we actually, one of the specialties you mentioned earlier in the show, is we specialize in investing in alternatives inside of retirement accounts.
Yeah.
And this is one of our niches, because very few people understand this can be done at all. But some of the mistakes that people have, and probably one of the most common ones, are that people just don't do their research. And this is not specific to alternatives. This actually is in individual stocks and mutual funds too. Is that people hear, I'll give you an example. People might hear on a podcast, somebody's selling, private mortgages, a fund that does private mortgages, or mobile homes, or buys real estate, or whatever it might be. And they tout their 10% or 20% returns, or whatever they think they can make. And people hear that and they say, oh my God, that's perfect. That's better. I'm I'm not worried about that because the stock market's going to crash and I need to invest in something else. And this is perfect.
Right.
I have people come to us all the time just saying, hey, I heard about this thing and should I do it? Like, well, have you done any research on it? Have you looked into who's running the fund, why they're, I'll give you an example, and I don't want to
Please do. Yeah, no, go
call,
ahead.
call them out, so I won't give too many specifics on it. But um, I had spoken to an individual. He called us a year ago and wanted us to, have our clients invest in his fund. And he was investing in a certain type of real estate, let's say mobile homes, for instance. And I think as an asset class, it's great. It's higher risk, but you definitely have higher returns on the real estate side. But what he was doing was investing in mobile home parks. And I was like, that's great. I know people who do it well and who understand it. They do quite well. And he's like, yeah, I've been doing it personally, and I wanted to start a fund to be able to roll these up and make good investments into larger properties and institutionalize it. I was like, that's a great idea. Nobody's done it. I think it's a fantastic idea. And maybe the fund is going to be good. I'm not going to characterize the fund, but I asked him one simple question. I said, well, you're investing in these. Are you investing in the fund? And he said, well, no, all my capital's tied up in these other investments. And I said, well, would you consider rolling them into the fund? And he said, no, why would I do that? I said, you got my answer. Why would I do that? Why
Very
would I
good.
invest
That
in
was
a
a good
fund
example.
that
Yes.
you're not committed to? And one of the things that we look at are the people involved putting their own wealth at stake. And some of the best examples of this are funds where people have 75-90% of their wealth tied up in their own fund that they're managing, and that's somebody who's committed to success. And I've seen so many, I don't want to call them scams because they're not legally a scam, but let's just say they're unethical
Right.
in their marketing process, and people just get bamboozled by it because they don't do the research. They look at the returns. They never look at the risk. What we do is we look at the risk first, and if you manage the risk properly, the returns will happen. If it's being done properly, the returns will happen on their own. But the risk and the risk management part is the most important thing, and people rarely ever consider it. And I think that's one of the biggest mistakes that people make, regardless of the investment, but especially in alternatives.
In alternatives, yeah. Safety, safety, safety. I mean, do your research. Even if you don't want to hire someone as an expert as you, Kirk, but I mean, I do believe that, there's certain people that sometimes are a little bit naive. They really, whatever they hear or see, they're looking at, like you said, the high percentage, because that's what they bring up, right? They give you the nice big numbers and people get excited about it, and they listen to this kind of things, alternative, and don't worry about the stock market and the bonds, but here's something better. Just do your research. Absolutely. I mean, it's like anything else. It's like when you start a business, anything that you do in life, I mean, it takes time, and it's important that, you have that information up front, and hiring someone like you, definitely it's a big plus to have us, as any type of investment that people can do out there. And as business owners, I mean, we want to protect our assets and what we have as a business, but we need to look at other things out there, because we're not always going to be healthy, and hopefully we will be at the end, but if not, I mean, we need to look at alternatives, and that's really important. So, Kirk, I want to thank you so much, for your time, your kindness, all the wonderful good tips that you have been able to provide us during this podcast, and I'm really looking forward, hopefully, to have you once again. And please let the audience know how they can find you, please.
Yeah, thanks, Liz. So you can easily find us at innovativewealth.com. We have a whole host of resources on our website for people to learn more about us, about alternative investments, self-directed IRAs. We put a lot of resources on there for people to get their feet wet and really learn, things that they want to know. And I also have a free gift for the show's listeners.
Thank you. Please.
Along these lines, and it's a list of, I think it's 75 alternative investments that people can consider for investment. We're not promoting anything. It's just a list of ideas. It can get the juices flowing in your mind of ideas that you can come up with that maybe you can that you hadn't thought of. And you can get that at innovativewealth.com /ETBS podcast.
Thank you.
And you'll find that there.
That's great. That's really good. And 75, that's a lot. So some people were probably thinking, maybe 5 or 10, but 75, that's going to give you a better view of what other alternatives out there and maybe things that people had not even thought about. So that's wonderful. And that's very generous from you. Kirk, once again, thank you. And I'm so glad that we have had you here, part of the podcast. And anyhow, happy holidays, by the way.
Yeah, you too.
Yeah, absolutely. Happy Thanksgiving for those who are listening to this podcast. So once again, thank you so much, Kirk, and to the rest of my audience. This is Liz Soria, and once again, thank you and happy holidays to everyone, and into the next episode. Thank you, Kirk, and take care. Goodbye.
Right. Thanks for having me on, Liz.
Thank you, Kirk. Bye-bye.